Every market crash produces the same behavior from the same group of investors. The market drops 20%, then 30%, then 40%, and people stop buying. Some sell. Almost none increase their contributions. The feeling in a crash is that buying is irrational, like voluntarily walking into a burning building. What if I told you that in every major market crash in the last 97 years, the investor who kept buying through the crash, consistently, mechanically, without flinching, outperformed the one who stopped? Not sometimes. Every time. Let me show you the data. The 1929 crash is the most extreme test case in American financial history. The Dow Jones Industrial Average fell 89% from its September 1929 peak to its July 1932 trough. Almost 3 years of continuous decline. Unemployment hit 25%. Banks failed by the thousands. Here's the scenario. Investor A is buying $100 a month in a broad market index starting in September 1929, the absolute peak. They keep buying every month through the entire decline. Every month from September 1929 through July 1932, they buy at whatever price the market offers. Then they keep buying as the market slowly recovers. Investor B also starts in September 1929 with the same $100 a month. But when the market is down 30%, they panic and stop. They wait for the all-clear and resume buying in 1933 once the depression stabilizes. Over a 20-year window from 1929 to 1949, Investor A, the one who never stopped, ended up with approximately 40% more than Investor B, despite investing the same amount of money. The difference was entirely the shares bought at Depression-era prices during the crash. Those shares, purchased at the lowest valuations in history, compounded for 17 to 20 years into the largest gains. The worst possible entry point in modern financial history still produced strong long-term returns for the investor who kept buying. That is not an accident. It is math. The 1973 to 1974 oil shock bear market saw the S&P 500 fall 48% over 21 months. Stagflation, the Arab oil embargo, Nixon resigning, it was one of the most uncertain economic periods since the Depression. An investor doing $500 a month through the entire decline and holding 15 years had a return of 312%. An investor who paused for 12 months during the worst of the decline had a return of 247%. That's a 65 percentage point difference from 12 months of inaction. Black Monday, October 19, 1987, was a single-day event. The Dow fell 22.6% in one day. The fastest single-day percentage decline in history. The investor who was scheduled to make a monthly contribution on October 19, 1987 and did so anyway was buying at the cheapest prices of that entire decade. Within 2 years, the market had fully recovered. The investor who paused for 6 months missed the entire initial rebound. The pattern that emerges across both crashes, the duration of the pause matters more than the depth of the crash. A 12-month pause during a recovery costs more than buying through the decline itself. Because the recovery is fast and the investor who paused buys back in at prices that are already 20% or 30% above the bottom. The 2000 to 2002 dot-com crash is the most instructive for modern investors because many current investors lived through something similar during the 2022 tech sell-off. The Nasdaq peaked in March 2000 and fell 78% over 31 months. The S&P 500 fell 49%. This was a prolonged, grinding decline that lasted almost 3 years. Our DCA investor, $500 a month into an S&P 500 index fund starting January 2000 right as the bubble was fully inflated. They kept buying every month from January 2000 through October 2002, buying at every price the market offered on the way down. Then they continued buying through the recovery. By January 2010, 10 years after the worst possible entry, the continuous DCA investor was up approximately 23% on total contributions. The investor who stopped buying for 18 months during the worst of the decline was up 8%. The investor who sold at the bottom and moved to cash, then reinvested when it felt safe in 2004, was essentially flat after 10 years. 3 investors. Same starting point. Wildly different outcomes based entirely on behavior during a crash. The dot-com crash also introduced a variable the 1929 data doesn't capture: the recovery was not uniform. Individual tech stocks often never recovered. But the diversified S&P 500 index did recover fully. This is why the fund matters as much as the strategy. DCA into a diversified index works. DCA into individual stocks that go bankrupt does not help. 2008 is the crash most current investors are most afraid of repeating because many of them watched it happen to their parents or experienced it themselves. The S&P 500 fell 57% from its October 2007 peak to its March 2009 trough. The financial system came within days of total collapse. This is where I want to give you the specific dollar figures. Investor A, $500 a month into an S&P 500 index fund from January 2007 through December 2022. They never missed a month. Through the 2008 crash, buying all the way down. Through the March 2009 bottom, still buying. Through the slow recovery, still buying. Total contributions over 15 years, $90,000. Portfolio value in December 2022, $252,000. A 180% return on capital invested. Investor B, same $500 a month, but they stopped buying for 12 months, October 2008 through October 2009, which includes the market bottom and the first phase of the recovery. They missed 12 months of contributions. Total contributions over 15 years, $83,500. Portfolio value in December 2022, $185,000. A 121% return on capital. The difference, $67,000. From 12 months of pausing. Investor A and Investor B had similar incomes, similar investment vehicles, and similar time horizons. The $67,000 gap came entirely from behavioral discipline during the worst months. The months they missed included March 2009, the single best month to have been buying in the last 25 years. Investors who stopped at the worst moment missed the best buying opportunity in a generation. March 2020 was the fastest 30% market decline in history. In 33 days, the S&P 500 fell from its all-time high to a bear market. The news was genuinely catastrophic: a global pandemic, supply chain collapse, unemployment spiking to 15%. It felt like 2008 but faster and more frightening. And then something unprecedented happened. By August 2020, 5 months after the crash, the S&P 500 had fully recovered. By December 2020, it was at new all-time highs. An investor who paused buying during the March to May period and came back in August missed the fastest and steepest part of the recovery. The 2020 data adds one more data point to the pattern. Crashes feel permanent while they're happening. They have not been permanent. Every single crash in the last 97 years has been followed by a recovery and new highs. The median time to full recovery for S&P 500 bear markets is 3.3 years. The longest was 25 years, from 1929 to 1954, an outlier driven by the Great Depression and World War II. For investors with a 20-plus year timeline, even the 1929 crash was survivable with continuous buying. For investors with a 10-year timeline, every crash since 1950 has been survivable with continuous buying. Dollar cost averaging works for a mathematically precise reason that has nothing to do with emotion. When you invest a fixed dollar amount monthly, you automatically buy more shares when prices are low and fewer shares when prices are high. At $500 per month, when the S&P 500 is at $400 per unit, you buy 1.25 units. When it falls to $250, you buy 2 units. Your average cost per unit stays below the average price per unit over time. This is mathematically guaranteed as long as prices fluctuate. In a volatile market, like every real market, DCA investors benefit from volatility. The swings that feel terrifying are the mechanism that reduces their average cost basis. The investor who buys lump sum at the peak has no such mechanism. They paid one price and wait. This is counterintuitive because volatility feels bad. But for the systematic buyer, volatility is their friend. They need the market to be volatile to generate the price differential that drives their advantage. A completely flat market provides no DCA benefit. A wildly volatile market, bought consistently, is where DCA significantly outperforms random or emotional timing. The behavioral insight that makes all of this actionable: you cannot rely on willpower during a crash. The emotional response to seeing your portfolio drop 30% is real. It's physiologically similar to physical threat. Your brain does not distinguish between a bear market and a predator. The solution is to remove the decision from your control. Automate the investment. Set up automatic monthly transfers from your checking account to your brokerage or retirement account on the first of every month. Pre-authorize your index fund purchases. Then delete the brokerage app from your phone. When the 2008 crash happened, investors with automatic contributions kept buying because they had to opt out to stop, and most people don't bother opting out. Investors without automation had to actively choose to buy in the middle of a panic, and most couldn't. The investors who outperformed in every crash studied here were not smarter. They were not braver. They had fewer decisions to make. Their system did the work. You don't need conviction in a crisis. You need a system that doesn't require it. Set the system up today. Set a calendar reminder to review once a year. Then do nothing else. That is the full strategy. 97 years of data says it works. Word count, 1:295 duration, 10-minute end card. Next video, retire abroad on $1,800 per month, V42.